It is Wednesday, November 21st, 2018. I'm Gort Long. As is normally the case, we have a lot of charts for us to go through, so therefore we'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates the global macro. Therefore, the slides this morning will focus on our other three report areas of our monthly report: global risk, regional, and U.S. economic developments. Specifically, I like to discuss developments in where we see ourselves to be in the economic and business cycle, what that means, and how we should view the timing of a potential recession. Most would agree with the general analyst consensus that we are late in the economic business cycle and that there is a recession coming sometime within the next 2 years. What does that mean and what do you do about it? To answer that question, let me first spend a little time on what our philosophy at MATA-SII has been in this regard and how we have effectively learned to position ourselves for it. Let me take you behind the curtain at MATA-SII, and I haven't done that in a while, and I think it's appropriate for the many new subscribers that we now have. It is critical to understand that everything an investor can try to do to improve performance falls under one of two headings: cycle positioning or asset selection. Cycle positioning consists of having more investments and more aggressive investments when the market is poised to do well, and fewer investments and more protective investments when the market is poised to do poorly. Asset selection consists of owning more of the things that will do better and less of the things that will do worse. As ridiculously simple as this sounds, few have a proven methodology that assures this occurs. Let's start with cycle positioning. Let's assume your goal is to have a defensive posture at the right time and an offensive posture at the right time. There are two possibilities to achieve that. First, you need to have a forecast of what's going to happen. You can do this by predicting psychology and guessing at how people are going to feel about things a year from now, how they'll feel about the market, the economy, company performance, the administration in Washington, etc., etc. But I don't think that this can be done successfully. Why? Simply said, our world is much too uncertain to permit certainty. We don't know what's going to happen, and just as importantly, we certainly don't know how the market is going to react to it. Let's go back 2 years to the run-up to the last U.S. presidential election. There were two things most investors were absolutely certain of. Hillary Clinton would win the presidency, and if by some fluke Trump won, the market would crash. But what happened was Trump shockingly won, and maybe more shockingly, the market went up. If that's not enough to convince you that forecasts don't work, I don't know what will, other than the losses many are incurring or have incurred. Getting back to cycles, we have found over the years that you must first have a sense of where the market stands in its economic and business cycle. Then you must determine where the market is in relationship to that cycle. Historically, the market normally can be expected to lead the business cycle by approximately 6 to 8 months. It is knowing where you are in the latter is what determines the largest percentage of your odds for your investment. When the market is attractively positioned, low in its market cycle, then the expected return is above average and you want to play offense. In contrast to that, when the market is unattractively positioned in the cycle, high in its market cycle, then the expected return is below average and you want to play defense. When you get this judgment right, then your results will be better than average. Pretty simple so far, right? Here's where it starts to get interesting. First, you need to know where you are in the economic cycle for your investment areas, i.e. the U.S., regionally, or wherever your country or exchange is, and then where you are in the global economic and business cycle. The latter is much trickier, which you'll see in a moment. With that under your belt, you then need to consider the main factors which influence where the market is in its cycle. And these are fundamentals, and you've heard me say this many times, fundamentals in the longer term, risk in the intermediate term, and sentiment, that is investor psychology, in the short term. Let's talk about sentiment. The market tends to reflect how the economy has been doing and how companies have been doing. But most investors think naively that if good things happen, stocks will go up, and if bad things happen, stocks will go down. But sometimes the opposite is the case. If expectations are too high, you can have good things happen, but investors are disappointed and stocks go down. Or you can have unpleasant events, but if they're not as bad as expected, the market goes up. Every event can be interpreted positively or negatively. For instance, rising interest rates can be a bad thing because it could crush businesses, but it also can be viewed as a good thing because it signals that the economy is strong. Why is investor psychology so important? Investors are not good at taking all the factors into account and balancing them. Usually they look only at the positive or only at the negatives. In real life, things fluctuate between pretty good and not so hot. But in the market, attitudes fluctuate between all good and all bad. That's what happened a few weeks ago when interest rates on the long end started to rise. So it's not enough to know what you think is going to happen event-wise. You also have to think about the psychology and emotion, because where the market stands and what the market does is the result of the interaction of what events occur and how people react to them. If you can understand what expectations are factored into the market and where emotion and psychology stand, then you have a better chance of getting the odds on your side. Risk. Think of a bowl full of lottery tickets. The makeup of the tickets changes as the market moves in its cycle. Let's say normally there are 60% winning tickets and 40% losing tickets in the bowl. But when the market is low in its cycle, it may be 90% winning tickets and 10% losing tickets. And when the market is high in the cycle, it's 30% winning tickets and 70% losing tickets. Before you decide to buy a lottery ticket, wouldn't you like to know the composition of the tickets in the bowl? In other words, if you think clearly about the composition of the tickets, you can get the odds on your side. However, even when you have the odds on your side, it doesn't tell you what's going to happen. You can have a bowl with 90% winners and 10% losers, and you reach in that bowl and you pull out a loser. All you can do is get the odds on your side, so your probability of success is better than neutral. And if you can do that repeatedly in the long run, you'll come out ahead. So how do you improve your odds when it comes to cycle positioning? It's very hard to make predictions of the future, but it's not so hard to assess the current environment. That's how you can improve your results, and it comes down to one understanding. Is the market hot or cold? Are investors optimistic, greedy, and risk tolerant? Are they fearful, pessimistic, and risk averse? When it's the latter category, that's when you want to buy. We want to buy when everybody discounts the positive and overrates the negatives, and the opposite is the case when we want to reduce our risk. Begs the question of timing, though, doesn't it? Because you may be holding it for a long time before things come in. And we'll get to timing. Let's talk about fundamentals. To understand the fundamentals, we must additionally appreciate the economic and business subcycles. They are the profit and inventory cycle, the credit cycle, and the monetary policy cycle. If you're finding this all too involved, then you can appreciate why the Meta SII site appears so detailed, involved, and possibly complex. You must understand all this and apply it to make a high probability investment choice. Let me schematically take you through how we do this at Meta SII in arriving at our Strategic Investment Insights, or SIIs. Don't try and read this illustration, but rather I just want you to see it as a roadmap of the illustrations I'm going to show you. Notice we start on the left with the country, then go global, and end with investments. First, we determine where we think we are in the U.S. economic business cycle. If the economy slows, are we entering a recession? Confidence suddenly drops, inflation continues to rise, inventory correction begins. The markets, the short rates would peak, bond yields would top out, stock market starts falling, commodities start falling, property prices top out. By the way, we have more rate hikes expected. We have major moves up in the last 60 days on bond yields. We have stock markets where we've seen some pretty high scares here in the last 60 days. Oil is plummeting, and residential real estate clearly looks like it's in troubles with interest rates. But that's not enough here yet. Having a sense of this for your primary market, I understand that many of you trade in other countries and on foreign exchange. Obviously, you substitute your country. My comments were directed at the U.S. market. Now we need to consider what many consider the global macro. This is where the real research comes in. We recently did a full video on the evolving globalization cycle and where we are in it from a technical analysis perspective. I encourage you to review it if you haven't already. It can be found on the MATA SII site and on our YouTube channel. We don't go through every country, but we do assess the countries we outline and regularly post in our macro research area, along with 3 times a year where we do a full regional focus on these particular countries and areas. This is where we stand globally today. China has an asterisk beside it, you'll notice, because we are using a growth recession premise here, where a significant decline in activity relative to a country's long-term economic potential is looked at. The growth cycle definition is used for most developing economies such as China because they tend to exhibit strong trend performance driven by rapid factor accumulation and increases in productivity, and most importantly, the deviation from the trend tends to matter most for asset returns. Next, we attempt to synthesize these differing points in the economic cycle globally for a consensus reference point so we can eventually bridge to the market cycle. You can see that sentiment, economic indicators, and fundamentals, along with monetary policies, play an important part here in coming up with a central reference point. With this under our belt, we move to an extremely important part of the synthesis. I and my colleague Richard Duncan have written extensively how we have moved from capitalism to creditism in the area of globalization and the debt supercycle. Therefore, the credit cycle is extremely critical and actually is the defining point in our analysis, or where our analysis really starts to squeeze us in a certain direction. The areas of defaults, margins, capex, dividends, buybacks, M&A, and EBITDA tell us about the global flows and liquidity, another area we highlight on our sites quite regularly. Armed with our conclusions on the global and country economic business cycle positioning, we now consider the market cycle. We try and see how far ahead the market is to the economic business cycle. The equity sector performance is a big add here, as well as subsectors and individual stocks like the FANGs, which are broadly held across the ETF index domination. The markets will be telling us where we are in the cycle, and there will be disparities, and it's in those disparities where your timing really comes into play. I know I have been moving through this quickly and at a very high level, but hopefully it helps you in assisting why we track so many indicators and subjects at MATA SII. Our synthesis continues to give us extremely clear MATA dates, timing zones, and biases, which you see in our charts and in our monthly reports, which we post, as I said, monthly as part of the MATA research updates. This post here back in April identified pretty well the timing tops for investment grade and high yield credit and the equities, and it's played out pretty well exactly at this point in time. It allowed you to time this extremely well with the instruments within our number 1 SII, the bond and credit watch list. You had plenty of time to be prepared for the shock that is hitting the ETFs such as the JUNK and HYG ETF. These telltales also help you identify exactly when we can expect the next U.S. and possible global recession. It is within 1 to 2 years, but it is being brought forward at an extremely fast rate as we talk. We should be talking numbers of months, not years here. You shouldn't be waiting for the recession to happen. The time to act is now. The markets signal the event, not the lagging economic information that I'm sure you're all well aware. That takes us to investment timing, not economic, business, nor market timing, but rather specific SII and investment vehicles, or if you're looking at the stock market, specific stocks. Here we find sectors, subsectors, and instruments don't all act as we would suspect. Another permutation shown here as our automotive SII, for example, where you can see most subsectors are short, which is exactly what we believed would happen and why we selected them, but one is long. The whited out areas are the individual financial investment instruments. Therefore, you can have sectors where some things should be long and some things should be short, and that is the trick. Many of our SII show similar profiles and both have short and longs. Our SII selection gets you into the areas that we expect movement in. Our process tells you when and in which direction that movement will then actually occur by the instruments we've chosen. This is where our extensive technical analysis and proprietary high probability trading zones, or HPTC, process all comes in. Here is the Apple chart as an example. We nailed the up in the FANGs and NOSH stocks, was one of our SII focuses in 2008 and prior, as we tracked it in relationship to the expansion of quantitative easing and the balance sheets of the central banks, which it clearly had strong correlation with. The key was to know, even though we were going into quantitative tightening, when in fact we should leave those particular instruments and for how long. Our process tells you when and in which direction. When it topped, we had a point at which it said we should exit our long positions, and then you can see a lower point where it said this, if it ever hits this level, that's when we short, and there's where our high probability trading zone is, and that's exactly what has happened. We're going to discuss this element of our process in a lot more detail in our December long wave video, since that is where we focus on the markets specifically and not here in our Under the Lens. But I wanted to wrap it together here just to show you that the methodology and process really does work very, very effectively. So in closing, as I always remind you, remember the answer will be they will print more money. You just don't know when, and you just don't know at what rate, and it changes the market. The printing of money is the only answer the politicians will ever agree on. So therefore you know it's going to happen. That's the wild card, if I can call it that, in this current market. And they will keep printing the money until no one wants it or trusts it. So therefore invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2018 turn out to be an outstanding investment year for you and your family. I thank you very much for listening.